So thanks everyone for coming along. We decided we'd do a budget update. So we're trying to run these webinars once a month, but we felt that there'd be a lot of valuable information on the back of the budget. So we decided to put another one on. So thanks for your attendance. Everyone should be on mute. If you're not on mute, I might get Pete to put everyone on mute just so there's no distractions and background noise. We will be recording the webinar, so we will send a copy of the link to the recording after the webinar. If you want to watch anything, pass it on to anyone or go back over some stuff that was discussed. We will send a copy of the slides around as well. This is an interactive webinar. We like to keep it pretty informal. So if you've got any questions, there's the chat box available at the bottom of your Zoom screen. Also, just take yourself off mute and ask away. We've got another webinar coming up, so it's our second last one for the year. If anyone's interested, Melanie Finlay from Risa and Sydney Jones is going to be talking about vegetation maps. That's probably more for the prime producers and rural clients, but if you're interested in that, then come along on the 22nd of October at 4:30. And before I hand over to Pete, I'll just reiterate, with the budget, just remember, like the budget announcements, they're still only proposals. Until they get passed through Parliament and legislated, they're not in place. So everything sort of we're discussing today could, and most of the time likely does get through budget, but like through Parliament, sorry, but it is very, very important you don't race out and do anything until it's all legislated. So Pete, I'll hand over to you.
Thanks, Brent, and thank you everybody for coming along, and for those that are watching the recording, thank you also for listening on the recording at a later point in time as well. As Brent said, we thought it'd be pretty important to provide a bit of a budget update, especially considering the year that we've all had with COVID, the coronavirus, and these unprecedented times really, especially from a budgetary point of view for our country and for the economy. There's going to be some quite significant changes. Now, the overview of the budget isn't erroneous. There wasn't a lot of, I guess, budget announcements or budget changes, but the ones that were announced were quite important for small businesses and our clients. So we thought it'd be best to go through them all with you guys as well. What we're going to run through today is purely just based on tax and super. So that the revenue collection side of the budget, the expenditure side of the budget, which involves a lot of construction projects, a lot of I guess programs, a lot of expenditure, that infrastructure that hasn't happened to that scale before. You can always go on the Parliament website and have a look at exactly what money is being allocated to what projects in the budget and things like that. And it is quite interesting. That's really quite long, but it is worth a bit of a read. And one of our partners, Darren, and I were having a bit of a look at it this morning. And it was actually quite interesting to see how much was for this region, but also for Queensland as well. So we're going to obviously focus on what we know, which is the tax side of it and what that means for businesses and how much money is going to go back into your pocket. But there's also the other side, which is the spending side, which is obviously going to help our economy by creating jobs and also by increasing the expenditure on the government as well. I'll just share my screen, and Brent, I can see you. So if you can let me know if I've done this properly or not, that would be fantastic. And can you see my PowerPoint, mate? Is that right? Yep. Okay, very good. So the slides that we have today, we've put a lot of detail on the slides, more than what we usually do. And the reason for that is just so that you can always go back and have a look at it and read in detail. Or if you want to flick it off to somebody that you know, by all means do. The more that this gets shared around, the better, because there is quite a fair bit of detail. I'm not going to read word for word from the slide, but I'm just going to give you my interpretation and also my thoughts around each individual budget measure that's going to occur, that's been proposed. I believe it went through, so I got introduced into Parliament today. I have been tied up this afternoon, so I don't know the progress of it, but they are trying to get it through pretty quickly. And I'm not quite sure what roadblocks there are at the moment from that point of view, but maybe Brent can let us know if he does some news.comming while I'm doing this. So the big one that, the big income tax change that was announced, which was effectively giving taxpayers up to $2,500 per annum into their pocket per individual, or $5,000 per couple, was effectively a shift in the brackets. So there was no actual tax rate change, but the actual brackets at which you pay tax were shifted. And that's going to commence on the 1st of July of this year. So they're actually backdating the bracket shift. So what the bracket shift was that the threshold for 19% personal income tax per our little table down here has gone from 37,000 to 45,000. So for those people that were in between the $37,000 and the $45,000 tax rate area, the most they're going to pay is 19% now, which is actually quite good. And when we do have quite a fair few clients that are in that sort of range, especially retirees and also low income earners as well. So that is quite a good measure that will save them some tax money from that point of view. But the big one that most of small business and also it affects a lot more people is that the 32.5% tax bracket will move from 90,000 to 120,000. So previously what it was that up to $90,000 in income, you would pay at no more than 32.5 cents to the dollar. And then it would go from 90,000 to 180,000 at 37 cents to the dollar. It's going to move to 45,000 to 120,000, all going to be at the 32.5% tax rate, which is really good news for those workers that are in between that $90,000 to $120,000 tax bracket range. It's also going to be quite good for those that have structures, simply because we may want to be sending more trust distribution money than what we have. Sometimes in the past, we've been trying to cap it at 90,000, which was that middle income tax bracket range. Whereas from a tax planning point of view, it obviously depends on each individual person's circumstance, but it could mean that we are able to feed through a lot more trust distribution incomes and the average rate of tax will be lower and the marginal tax rate won't go above 32.5%. So quite important change. Now, how it's going to come about, there's been a lot of talk in the media that it's been backdated to the 1st of July. What that effectively means is that this will occur and come into place for the 2021 income year. Now, if you're an employee, what that means is that sometime in the next few weeks, the tax tables will change and that employees' rate of pay, net pay, not actual gross pay, what they receive in their pocket, will increase and the level of tax that they pay per week or fortnight or month will decrease up until the end of the year. And then at the end of the income year, they'll expect to get a bit more of a tax refund for the 4 months in which their tax rates were at the old tax rates based on the previous budget. So employees will get money in their pockets essentially every week, additional money. Then also at the end of the year that we're expecting that they'll receive a bit more of a tax refund or less tax to pay, whichever situation you're in, to catch up for those 4 months as well. Had some questions in the last couple of days is, well, as an employer, what do I do? The answer is make sure that if you are not on, or if you are on any sort of accounting system, that you have the most up-to-date version of your accounting system as possible and that your tax tables are always up to date. And keep an eye out for that in the next few weeks. So that's if we're talking, if you're on MyOb, for example, or Phoenix or Reckon from there. If you're on Xero or QuickBooks, they update automatically in the background. You don't have to really worry about it too much. You won't notice anything different that you need to do, except for that what you pay your employees will be a bit more, and what you pay the ATO and pay-as-you-go withholding will be a bit less.
Hey, do like something like a Xero? Do they like give like they have like when you log in, they'll say your tax tables have been updated or something like that, just to let you know?
I'll send out a general email, mate, from there to let everyone know that when it happens, so that all Xero users will get that. QuickBooks is exactly the same, so we get that as well from them. But it's not an actual update of the program for those ones, simply because they're internet based. Whereas if you're on a MyOb, for example, and you have the program on your computer, you need to actually download an update file, which will come through the next few weeks as well, so that you're withholding the right amount of tax for your employees. So that was the biggie that came out of the budget. That was the most, I guess, publicised tax one. That was the one that was on the front page of all the the newspapers, and it was on the top of news.com. And it's the one that affects everybody the most, I think. If you earn over $37,000, you get a tax decrease or a tax cut effectively simply by the way of having your bracket moved up with the amount of rate of tax that you pay from there. However, if you're a low income earner, you may not necessarily get the bracket creep or the effect of the bracket creep, but what you're going to get is an increase in the low income tax offset to offset that. So those changes also apply from the 1st of July 2020, which means effectively that the rate of tax that you pay and the rate of the tax offset is going to increase to $700 per year compared to $445. Now, the low income tax offset effectively means that the tax-free threshold isn't $18,200. It's actually more along the lines of $20,000 to $22,000 from there. So it just means that the rate that you pay tax on those lower income thresholds is actually less because of this low income tax offset increasing. And so it goes from $445 to $700 up to $37,000. So from an individual taxpayer point of view, that was pretty much it in the budget. From there, there wasn't anything as far as any sort of major or minor tax reform. In previous years, there's been certain deductions that have been allowed, certain deductions that haven't been allowed, etc., etc. The only other additional thing that we haven't included in these slides is that the working from home rate or the COVID working from home rate has been extended out. It was initially due to stop in June. Now that was the 80 cents per hour if you're working at home post the middle of March. They've extended that out until the end of next year. So that is a bit extra for individual taxpayers. But apart from that, there's no increase or decrease in any sort of budgetary measures that have been announced on Tuesday night from there. Can I go through what's going to affect small businesses and also medium businesses? And these are the sort of changes that are most going to impact our clients, which we think is a very good thing. The first one doesn't apply to too many, but I do need to put this slide in here simply because it will affect somebody that you know, or it may affect yourselves if you're in that sort of category turnover. But there was the small business tax concessions, or what you were known as a small business entity, used to be up to $10 million in turnover. That's been lifted to $50 million in turnover. And it effectively means that a business up to $50 million in turnover gets exactly the same concessions as somebody that's turning over $200,000 or $500,000. You might say, well, that doesn't mean much for me, but what that does mean is that those sort of medium taxpayers are going to pay a lot less tax this year, which the government hopes will obviously encourage increase in expenditure and increase in investment from there. Those concessions are over a stage period. They get some FBT concessions in the slide. They also get immediate deduction for startup costs. But from the 1st of July next year, they'll be able to access the instant asset write-off, the small business trading stock rules, pay-as-you-go installments and things like that as well. So fairly big announcement from a tax point of view. Government is looking to lower the tax burden for those businesses, which is obviously in turn, the aim of that is to increase stimulation in the economy and more spending by those businesses because they have less tax to pay from there. I know it mightn't affect much of us, but bigger picture wise, it is a very big measure for the economy that those taxpayers are now classed as small from there. Another big announcement was the job maker hiring credit. Now, this one's been also splashed around the papers and things like that. And what it is effectively is that the government is going to give employers credit for hiring employees as of last night. So new jobs created, sorry, it wasn't last night, it was the night before now. New jobs created after the 6th of October 2020, or from the 7th of October 2020 until the 6th of October 2021, Employers can claim a credit of $200 a week for each additional employee they hire between the ages of 16 and 29. And if you hire somebody between 30 to 35 years old, it's $100 a week. Now, how it's actually going to work and how you get your money back is something that the ATO has been charged with administering, and it will be claimed quarterly in arrears by the employer from the ATO from the 1st of February 2021. So I did a bit of reading on this today. There's a lot of speculation that it would be a separate claim, which is different to what I thought yesterday, but they're talking about it being similar to how businesses currently do a separate claim for JobKeeper. They'll have to do a separate claim through the ATO business portal for your JobMaker hiring credit, which sort of makes sense to me. That's what they're indicating. Whether or not that happens or not, there's going to be a lot of literature that comes out the next point in time. That's going to be capped at $10,400 for each additional new position created. So, which is 52 weeks for $200. And the total credit claimed by an employer can't exceed the amount of the increase in payroll for the reporting period in question. So in other words, in that you have to increase your payroll more than what you get back in JobKeeper credit or JobMaker credits. And the emphasis on that is to make sure you can't effectively fire someone, then rehire somebody on JobMaker and get the credits for it. They want to see an increase in your payroll over the period of time before you get back the JobMaker credit. So you can't have a decrease in your payroll. You actually have to have an increase in your payroll for this to happen. Now, there's one big catch that employers need to be aware of, is that they need to have, obviously you've got the age requirements, which is between 16 and 29 years old, or 30 to 35 years old. Commenced employment after the 7th of October. You need to have worked at least 20 hours per week on average for the weeks that you claim the JobMaker credit for. But you have to have received either the job seeker payment, the youth allowance payment, or the parenting payment for at least 1 month in the past 3 before they were hired. So effectively what the government's trying to do here is encourage employment of employees who were previously on Centrelink benefits. So a question I had today was, can we employ somebody who works at a competitor and get the JobMaker credit? Answer is, unless they've had one of those 3 payments in the last 3 months, then you can't get the JobMaker credit for it. So it's purely aimed at employing those that are currently or have previously been the last 3 months on some sort of government benefits. And they must be in their first year of employment with the employer. So it must be employed for the period that they're claiming for. So you can't go and fire someone and rehire them, essentially. So that's a very important one from there. And certain exclusions apply, which includes employees for whom the employer is receiving a wage subsidy under another Commonwealth program. So if you're getting the apprentice subsidy, the understanding is that you won't be able to get JobMaker as well as the apprentice wage subsidy scheme. So it is quite restrictive, especially I was talking to somebody else today and they said it's not going to be really widely used in this region. There will be certain circumstances where it will be, and that's going to be quite regular, but there's going to be a lot of employers that won't be able to do this simply because the perception in our region is that employment is still pretty strong in comparison with other regions and capital cities, etc., etc. But it is definitely worth looking at if you are struggling to find employees and you do have someone in mind that's been on those 3 payments. As an employer, you have to be up to date with your tax lodgements, have an ABN, lodge through single touch payroll, be on page with withholding, do all the right things essentially from there. Keep adequate records of paid hours, and able to demonstrate that the credit is claimed in respect of an additional employment job that has been created. So that's, here's my little highlighter. That's this one here. So broadly, there must be an increase in the business's total employee headcount for it to happen. That's an interesting one, because if somebody resigns and you need somebody else, will you get job maker credits? Per what the initial reading is that may not be the case. You actually have to increase the amount of employee headcounts that are on your books for that to happen. Importantly though, you do not need to satisfy a fall in turnover test. So it doesn't matter if you're increasing your turnover, you still get the job maker credit. But certain employers are excluded. Obviously, if you're claiming the job keeper payment, then you won't be able to claim the job maker credit, because you are receiving a subsidy for those employees already on JobKeeper. Hopefully, Brent, does anyone have any questions about the JobMaker program? Hopefully I'll run through that one.
Yeah, I've got no questions there at this point, unless anyone wants to sing out.
If you do at any point in time, just yell out. I'm happy to answer it. But the big one that got us all very excited from a business point of view, being obviously predominantly business and retirees in our sort of firm, is that there is no limit for the next, well, until 30th of June 2022, which is, I guess, essentially 20 months. There's an uncapped immediate write-off for depreciable assets. So if a client wants to come in and buy a $500,000 piece of equipment or an $800,000 piece of equipment, there is an immediate write-off for that asset. So that was previously $30,000, and then when COVID came, it was $150,000. The government, as of 7:30 on the 6th of October, have just allowed any asset to be immediately deductible for the next 20 months, which is really quite good in encouraging business investment. From that point of view, it's also going to mean that a lot of our clients who are looking to invest are going to have quite a decrease in their tax bills, which is going to be quite handy as well. Because previously it was only up to 150,000. There was a lot of, I guess, unknowns as to whether that program would continue into the first half of next year, but we've got some surety that the program is going to continue until the 30th of June 2022, which is really quite good. The second part of that, and I won't go through all the details, you have to have it installed ready for use by 30th of June 2022, and it has to be a new depreciable asset or the cost of improving an asset from there. Your turnover has to be less than $5 billion, which I'm pretty sure all of our listeners will be. The other thing is that from that point of view, small businesses can deduct the full balance of their small simplified depreciation pool at the end of the income year while full expensing applies. That is going to be quite handy for businesses that you may not buy an asset between now and the 30th of June 2021 in this tax year, but you still might get a very good tax deduction because of previous assets you purchased and the pool balance that you have in place at that point in time. Now, we have already written off quite a fair few small business pool balances at the 30th of June 2020. But for those that have still got pool balances carried over, we've got quite a few clients, they'll be written off at the end of 30th of June 2021, which in a lot of cases is going to mean that there's going to be very little tax to pay in this year if you've got an existing pool balance. Now, if you're unsure whether or not you've got a pool balance or not, a good place to look is your tax return. Under the business schedule, there's always a spot there which says closing pool balance, or just ask your CANARS accountant and they'll be able to tell you exactly what your pool balance is at the 30th of June 2020 or what it's going to be at the 30th of June 2021. So tax planning is going to be quite important this year because we are going to have some quite fairly big deductions that we might not already have had, which means that there's other opportunities for not spending money this year, but spending money next year when we're not going to get that deduction. But yeah, big one is the uncapped immediate write-off. And also from there is that the pool balance will be written off if you've got one that's been carried over from 30th of June 2020. Just flip to my next screen. The next measure goes hand in hand with the uncapped depreciation limit or the uncapped immediate write-off limit, but may not necessarily, is that the temporary loss carryback for eligible companies has been reinstated for the 2021 and 2022 income years as well, and 2020 year also. What that means is that if a company had a loss in either the 2020, 21 or 22 years, you were able to claim back a tax offset for previous tax that you've paid in relation to that taxable loss. So the taxable loss will offset the taxable income from the previous year, and you'll get a tax credit for the difference, essentially from there. So a good example could be a company might have a $100,000 loss in the 2021 year. They might have had $200,000 income in the 2020 year and paid $60,000 tax. What the $100,000 loss will do will create a tax credit of about $27,500, which the client will get back. So previously what happened, if you had income tax in a previous year and you had a loss in the next year, the loss would just carry forward. But this time they're allowing you to go back to the 2019 year and claim back any tax credits that can be offset against the loss, which is quite handy. That's going to become hand in hand, especially for those companies that have got that big depreciation claim, which may drag their company taxable income into a loss. That could enact them to get some tax credits back from previously paid tax. The other thing is that if obviously with COVID for 2020 and it's been a bad year, we're able to then claim it back against the 2019 year as well, which is quite a good measure. Companies that do not elect to carry back losses, so you don't have to do it. You can still carry losses forward if you wish to, but if you want to get the tax back, you can do it from there. We're all good still?
Yeah, all good, mate.
Cool. They're the major income tax changes that have occurred. So sometimes in budget nights, we get 30 or 40 pages worth of small details and things like that. Whereas this year, they've really focused on some big spending, big bang, and a limited amount of legislation to make sure that that happens, which I guess it's not real tax reform or tax improvement. It's just doing what's best now for the economy from that point of view, which I guess is understandable. There's been a couple of FBT changes or simplifications to FBT. They may not necessarily apply to our guys, but it's also important just to know that FBT will be exempt on retraining and reskilling benefits provided by an employer. So if you're looking to make somebody redundant or if you are putting somebody off, you are able to provide them with some retraining or reskilling programs, and that is tax deductible to you as the employer and not taxable to the employee. So you may wish to think about that if you're in that position as a way of providing a payout or redundancy and being able to try to reskill the employee from there. FBT record keeping is also going to be reduced, which is going to create a big smile to some people. They're going to rely on existing corporate records rather than employee declarations for FBT returns now. So previously, you had to go and get an FBT declaration from your employee stating that there was X amount of private use or they did X amount with certain company assets or certain payments. Now they're just going to rely on your records in order to do that. So they're going to simplify the process from the FBT compliance regime, which is quite a good one from there. A couple of other announcements before I hand over to Brent. Removing the CGT for granny flat arrangements. So this one was the one that snuck in at the end. So what it is that if you sell a property to a family member, but you wish to live in the property or you wish to maintain tenancy, then they're going to CGT exempt that property when you transfer it to a family member. So it involves older Australians or people with disabilities who transfer their home or the proceeds from the sale of their home to their adult children or another trusted person in return for the promise of ongoing housing and care. That can be used sometimes, may not be used, but it is quite important that that has happened. And it's just with estate planning and things like that, elderly people do like to have their affairs sort of tied up before they pass away, but this is a way of doing it without incurring any sort of capital gains tax from there. So capital gains tax will not apply to the creation, variation or termination of a formal written granny flat arrangement, provided accommodation for older Australians or people with disabilities. That is the budget wrap up in a nutshell from me. There's a bit of superannuation stuff to come from Brent, but the big takeout from my point of view before I do hand it over to Brent is the income tax bracket changes is a good thing for our clients as far as being able to stay on the 32.5% tax bracket for a longer amount or a higher income amount up to $120,000. The uncapped depreciation is a brilliant one until the 30th of June 2022. So we don't have to rely on worrying about what was going to happen at the end of December. And we're able to write off the small business pool balance at the end of the financial year as well. And if you do operate in a company and you have a loss this year, you may be eligible to claim back tax that you previously paid in the previous 2 years as tax credits, which can help out from there as well. Because there's nothing worse than thinking, oh, we paid heaps of tax in 19 and now we've got carried forward losses in 2020 and 2021. So we may be able to get those tax credits back, which is a good thing, especially when we're in loss-making situations at the moment. I might hand over to you, mate. If we've got no questions, that's all right. I'll take.
No questions at this time.
Cool. Go for it.
Good. Thanks, mate. As Pete said, we've got a lot of detail here with regards to the superannuation for you to have a look at. But in essence, there wasn't a great deal of changes to super, which I know a lot of people will be happy about. In 2017, there was major reforms. So these changes are really just trying to help people consolidate their super, stop having multiple accounts, stop wasting money on fees and unnecessary insurance premiums, and really to sort of, they're using the word stapled. So they're wanting that one super fund is to follow around the employee, even if they have multiple employers, and stopping employers from creating default funds, really. So that's only going to be good. I think the government estimates that it's costing Australians around $450 million. So if that's better back in individual pockets, then surely that's got to help people with more money for retirement and less reliance on the age pension. So that's that one. They're going to try and hold a lot of, back to the previous slide, mate, sorry.
Yep.
They're really also after holding to account these super funds for underperforming. So at the moment, they're looking at the My Super products. So they're the ones, the government mandated funds that need to be simple, need to be low on fees. But by 1 July 2022, they're looking to go to all superannuation products. So again, that can only be a good thing. They're just trying to keep super funds on their toes, trying to keep more money in members' pockets, which can only be good for everyone. And they're going to also have an online comparison tool. So I'm hoping as well that will allow a much easier apples with apples sort of comparison ability for people to easily see what their super fund's doing and what fees they're paying. Next one, please, Pete.
It's just the insolvency provisions at the end of it, that's all. So
yeah, so other than those superannuation changes there, they're going to, so if you had a Commonwealth Seniors Health Card or an age pension, you got 2 lots of $750 recently. So they're going to do another 2 economic support payments of $250, and they're going to turn up in people's accounts in December and March next year. So that's a little bit of a boost there. And the other one, just because I'm really passionate about aged care, they're actually going to allocate another 23,000 home care packages. So for those that don't know, home care packages, they're pools of money that are allocated to people who need some assistance at home. And the best thing about a home care package is that people can stay in their home. They can get a bit of government assistance to help them out, to help get services in, mow the yard, help them do the washing, without having to go into an aged care facility, which is not a good outcome for anyone because it's very costly for both the person going in and the government. And let's face it, they're not a great place. So yeah, really, really happy to see that there's some more home care packages being released as well.
That's similar to like NDIS, isn't it? It's something it's based on the NDIS model for aged care, isn't it? Really, in-home aged care. Is that right?
Yeah, there's four levels there based on necessity, and there's a means test there to sort of help, so everyone can sort of get a bit depending on their means, and if you have a bit more means, and you're asked to contribute a bit more as well. But yeah, it's really helpful for people to stay in their own home. That's where people want to be. They don't want to go into an aged care facility. So it's, yeah, as I said, it's a good outcome all around. But from my perspective, I was pretty happy with the budget. There wasn't too many changes. They're not tinkering too much with super. So yeah, good outcome.
Sometimes it's in these sort of times of, I guess you can call it uncertainty or a big change in other factors. You sort of want the tax and super system to be relatively stable, don't you, really? And any change to be very small.
Yeah,
that's what's happened here. Like even the tax bracket changes, no one's really going to notice it too much except for a little bit more money in your pocket. There's no big changes at all. And the instant asset write-off thing is only a positive more than anything as well. So there's not a lot of, as I said, the summary that we've got mainly that a lot of people are pulling out one-page summaries now, but there's like the in-depth summary is only 9 or 10 pages, and that's unusual. But I think that's warranted in these times, isn't it, Brent? Really? So
I just said that it's after the big ticket items. They're going to get jobs and people spending money to get the economy going again.
Yep. Did anyone else have any thoughts or any questions around the budget? Helen, I can see you're online. What were your key takeouts out of it that you saw? I'm sorry to put you on the spot here, but what were you thinking about it? Sorry.
May not be there.
May not be there. No, that's okay. Anybody else got any questions or comments about it before we wrap up?
Other questions in the chat box, Pete? So
We're all good?
I think so. Short and sweet.
Well, that's exactly what we just wanted to provide a brief overview of what we saw. We've also sent an email around to everybody that's on the Canars mailing list. So that would have come around about 1 o'clock today. There'll be slides and also a recording of this go around probably even tomorrow or Monday now. So, but feel free to send it around to whoever else that you know for a bit of an update. That'll work well fine too. So, very good.
Very good. We'll call it. Thanks for the feedback, Elizabeth.
Thanks, guys.
Very good. All right. Have a good afternoon.
Yeah, I hope you all have a great afternoon. Thank you for tuning in or watching. And yeah, any questions that you've got, yeah, please don't hesitate to see one of your Canars accountants. Cool. Have a great afternoon.
Good night. Bye.
Cool.